Hi, everybody. My name is Sam. I'm going to be talking about depreciation in accounting for our ACC 202 Milestone 5 project for spring 2025. So just an overview of kind of everything we're going to be talking about today. First, we're going to really talk about what is depreciation. Then we'll jump into different depreciation methods, whether that's accounting depreciation or tax depreciation. From there, we'll talk about how the IRS views depreciation and how that affects your taxes, as well as comparisons between the GAAP versus IFRS procedures when it comes to depreciation. Before we get started, we've just got a couple terms that I think are going to be super helpful as we continue. The first being useful life. So we can think of useful life as the estimated period during which an asset is expected to be economically productive and generate some sort of value for a company. So as soon as that asset, whether it be machinery, a vehicle, once it's no longer creating value for a company, we would no longer consider it useful. Moving forward, we've got tangible versus intangible assets. And tangible, if we think of the root words, just means touch. So a tangible asset is something that you can touch, like a building, machinery, something inside your building or your warehouse, whereas an intangible asset could be something like a copyright. It gives value to your company, but you can't physically touch it. Next is wear and tear. So when we get a physical asset, it's expected that over time with normal use and normal maintenance, that it is going to deteriorate and lose some value. And that's why depreciation is so important, because we know that's going to happen and we can account for it. And then finally, an appraisal. So you might hear me say fair value price, but an appraisal is a way of saying you're looking at something and you're determining how much it's worth based on what you're looking at that day. So appraisals can happen on machinery, vehicles, property, houses. It's essentially just determining how much something is worth, and you can use that number for your formulas moving forward. So what is depreciation? Depreciation is a method to use to spread out and allocate costs of an asset over a period of time. And we use the fair value cost of the asset in mind when we're determining those depreciation expenses. Why is depreciation important? When we purchase an asset, like we talked about in the last slide, it is going to lose value over time. So if you've got your expenses for this asset, as it's providing your company with less value, less income, you don't necessarily want to be having the same expense. So depreciation is a method to kind of spread that out over the useful life. And we're going to break depreciation down into accounting versus tax. So for accounting depreciation, we've got 4 different methods that we're going to go over today to help you determine what that balance is going to be, or sorry, that expense is going to be for your depreciation. We can also think about accounting depreciation as more periodic. You're determining these expenses for maybe a month, a quarter, half a year. Whereas when we get to tax depreciation, it's not quite the same thing. So we'll start with the straight line method. To find your straight line depreciation expense, you'll take your asset cost, you'll subtract the salvage value, and you'll divide that by the useful life. So with straight line method, your costs are going to be the same over the entire useful life of the asset. For a double declining balance, you take your purchase costs, you subtract your salvage value and divide that by the useful life assumption, multiply that 2, and then multiply that by 2, and then multiply by the beginning PP&E balance. So PP&E stands for property, plant, and equipment. This is a little bit different because the amounts you're going to pay are going to slightly change. Your units of production. So this one would make the most sense for some sort of machinery if you're a producer and you generally have an idea of how many products that machine can produce. So for your depreciation expense, you'll take your cost basis of your fixed asset, subtract your salvage value, and divide that by the estimated production capacity. And then you'll multiply that by the actual number of units produced. So you've kind of got your estimate versus what actually happened. And then finally, your sum of years digits method for depreciation, taking the remaining useful life, dividing that by the sum of the years digits, and multiplying that by your depreciable basis. Moving forward, we just talked about accounting depreciation. Here we've got tax depreciation. So when you are filing your taxes, some of your assets may qualify for a tax deduction based on that depreciation. In order for that to be the case, your asset is a property owned by the taxpayer. Taxpayer uses the asset in an income generating activity. The asset possesses a determinable useful life, and the asset's useful life is more than 1 year. Connecting our tax depreciation to the IRS and just kind of breaking that down a little bit more. According to the 2024 tax laws, property can be depreciated if it's leased property, as long as you retain the incidence of ownership, purchase of a rental property, a vehicle for your business, a life tenant, or a co-op apartment. Property that cannot be depreciated as of 2024 tax laws is land and expected property. And then just thinking back to kind of the origination of depreciation with the IRS. So prior to 1987, if you purchased an asset, you would use the ACRS method, which is the accelerated cost recovery system. Prior or following that, from 1987 on, businesses are supposed to use the MACRS, which is the modified accelerated cost recovery system. And when filing taxes, if you are able to take these deductions, you'll need to complete a form 4562. And then finally, just differences in common practice if we're discussing GAAP versus the IFRS. You kind of think of GAAP as the standards or the rules that we follow in the United States for domestic business, whereas the IFRS is more of a global standard. Another way to think about it is the IFRS kind of sets the standards. GAAP uses those standards, those influence how GAAP is going to operate, and then GAAP forms rules. So it's kind of a standards versus rules situation. And then if we're really getting down into it when we're depreciating, the differences in how we account for inventory, write-downs, development costs, and fixed assets are different. So that's going to change how you depreciate. I've got my works cited and all images were taken from Wall Street Prep. Thank you.